Ajay, let's talk about the movie exhibition space. While of course it's a monopoly out there, but does it seem like it's not going to get back to its heydays as it were the case post we all discover OTT?
Well, from a consumption viewpoint, it's a good sector, but it's just too small, as you mentioned, very small really to track, and it's a one pony sector. So overall, the trends are against the sector in terms of OTT taking up most of the space. You need blockbuster movies, and all the uh, all the uh, what we are seeing, the news around Pushpa 2 will lead to some amount of froth in particular stock. But overall, we've got a lot more consumption plays, and you don't have too much choice in the sector as such. But the trend globally is towards OTT grabbing more and more of the market share.
More and more of the market share, that of course is something that one needs to watch out for. But just taking stock of what else is happening in the market right now, you do have the likes of HEG and Graphite India doing quite well for second straight day. KEC International is up now 11%. We just spoke with the management, I think this week itself, and the management sounded fairly confident about their growth roadmap. We'll try and pull up a soundbite from that one. Honasa Consumer is sitting with decent amount of gain. RBL Bank, Aisha just pointed out. You also have a Macrotech Developers which has suddenly spiked 6%. Ubra Realty has been doing well, 4.5%. Ajay, over the last couple of days, we have seen some fresh initiations on the real estate company. UBS did on the entire sector yesterday. Today, Nomura on Ubra Realty. What's your take? Time for a fresh relook at the real estate pack, or they are adequately priced?
What has happened is that over the last 3 years, post the peak of COVID, we have seen real estate do very well. I would say priced quite well already, priced to perfection. So very difficult to really justify. Of course, when new luxury projects come in and you see everything getting sold very fast, then you tend to look at the sector afresh. But I would say you're better off in the industrial infrastructure space, in the construction space, in the implementation part of the infrastructure business. Then these real estate majors, they have cleaned up the balance sheets. The good news is with good regulation and smart moves, all these companies which have survived are the real winners, and they will be multi-year winners. But valuations becomes an issue, and behind the headlines, if you see, it's more that people have committed money partially. All those kind of things are behind the headlines. But given all that, there is a big demand at the upper end of the market, and most of these players are in that. We have seen some South-based players showing not so good numbers and not having that many approvals in place in various states. So, it's not a very similar pack. I think North-based players are much better off. We have seen NCR prices going up and projects running very fast. So you have to look at the balance sheet. You have to look at the kind of projects they have in hand, and how soon those will be coming onto the P&L. Those are the issues, and I would say that you're better off on the industrial infrastructure capex side of the business, or even on the cement place, rather than the real estate players at this part of the cycle.
Okay, point taken. So that's the view coming in on the real estate stocks. You know what, we're watching out for the OPEC meeting tomorrow. The expectation is that there will be, some action there, and the RBI MPC meet, of course, is underway. We'll get you the previews on both of them, and we'll get Ashesha as well as Gaurav to join us to talk to us about the expectations. But before that, let's hear out what the KEC management had to say, because that stock is up 11%.
Order target has been around 25,000 crores. And we have now touched around 16,300. So the balance, roughly around 9,000 crores, should be coming in Q4, or from now onwards till Q4. We already have an L1 of around 6,500. So I do expect that Q4 would be better. 15% at 23,000, I think is a good target. I am not sure whether we'll be able to exceed it. But with these orders, what will happen is that our next year's growth also, today our order book plus L1 is around 42,000. So with this, I think we expect that next year also we should do another 15%. If you add 15% on 23, will probably be around 26, 27,000 crores next year. We have been talking about a 9 to 10% margin in FY26. So whether it would be 9 or 10, difficult to predict today, but it would be closer to 10, I think, or that's our hope. We hope that we'll touch 10, but 9 to 10 is definitely a target which we have set out for ourselves in FY26. FY25, we have maintained that by exit, we should be around 9 to 10%. That's how we'll be 9 to 10 in FY26. For FY25, we have been talking about 7.5%. I'm hoping that we will be able to meet the target of 7.5 for the whole year.
Okay, so that's the take from the KEC management. But as promised, let's hop across to Ashesha to get a better sense as to what the expectations are from the OPEC Plus meet. Ashesha.
Well, yes, all eyes are on OPEC Plus meeting, which is scheduled to happen on the 5th of December. Remember, the meeting was originally scheduled to happen on the 1st of December, but was later postponed. And the main agenda of the meeting is to review supply for 2025. Now, the expectations are that production output revival, which was scheduled to happen earlier this year, will be revised yet again, will be delayed yet again for another 3 months. Now, the output revival of about 180,000 barrels per day was expected to happen from January 2025, but it is expected to be delayed by another 3 months. So all eyes on OPEC Plus meeting. Remember, demand continues to be a challenge for global oil market. China is the biggest consumer and importer of oil, and slower demand from China is one of the main reasons why oil demand globally is a concern. And apart from that, apart from OPEC Plus, other countries are also reviving and increasing oil in output. So those are some of the reasons why demand continues to be a concern. But all in all, expectation is that perhaps oil production revival is expected to be delayed by another 3 months, and all eyes on OPEC Plus outcome, which is expected to come in tomorrow.
Okay, Ashesha, we'll leave it at that. Well, there's also the crucial MPC meeting which kicks off today as India continues to face the elevated inflation and softness in growth. The committee is largely expected to hold policy rates and maintain their stance, but the focus this time is going to be on liquidity management, according to experts. In fact, Gaurav joins in to tell us what his poll of bankers and economists is penciling in.
Well, yes, RBI MPC meeting has begun, and let's rewind and see what has happened between previous RBI meet and today's RBI meet. We have already seen two big events happening. So first, let's talk about CPI, which actually crossed that 6% mark and also was at a 14-month high level in the month of November. And at the same time, when we talk about GDP growth, for second quarter, we saw the GDP growth was slowest in the last 7 quarters. The GDP growth came in at 5.4%. So given all the factors, now the question remains is that during this meeting, can we see a rate cut? Now, experts believe, around 81% of the experts believe that we will not see any kind of rate cuts even in this meeting. And the reason being that RBI may focus on the inflation, because when we talk about inflation, 2 to 6% was their resistant band, and inflation has already crossed that 6% level. So experts believe that RBI will still remain constant on what they have said. They will keep the rates unchanged for the 11th consecutive meet. Apart from that, when we talk about the growth, experts are expecting some kind of push coming up from RBI in terms of growth. So when we talk about growth, interest rate is not the only tool. What RBI can do is that RBI can tweak the CRR ratio, which is cash reserve ratio. So when we talk about this ratio, before COVID, this ratio used to be at 4% level, which was raised to around 4.5%. Now experts are believing CRR ratio can be cut down once again to 4% level. They're expecting 25 to 50 bips cut in CRR ratio. What it will do is that it will actually give some kind of boost in terms of liquidity for the banks, and that is the reason why experts are expecting some kind of changes in CRR ratio. Other than that, any kind of commentary coming up from the GDP and inflation angle is going to be crucial, because when we talk about both the numbers, we have seen actually numbers are actually missing what the RBI had estimated. So we can see some kind of tweaking happening in the estimates as well. Other than that, any kind of commentary in terms of the dollar strengthening, any kind of commentary which is coming up on the geopolitical events will be something to be watched out for. And lastly, let's also not forget that RBI's governor, Mr. Shaktikant Das, is going to end his term on the 10th of December. So any kind of commentary coming up on this angle, is he going to extend his term, is also going to be something which is going to be crucial for the commentary. But overall, when it comes to rate cuts, experts are not expecting any kind of rate cuts, at least in this meeting from RBI.
Not expecting a rate cut, but let me toss it to the expert on the panel. Ajay, you track the macroeconomics very closely. With the kind of GDP print that we got and the kind of setup that we have at our hand, is there any possibility of a rate kind of action? And more importantly, what's your own sense as to the RBI governor? Do you expect him to extend his term? Are we perhaps likely to see a new face? Anything that you are hearing?
Well, the money markets would like him to extend his term. He's had a pretty spectacular term, and he has been consistently ranked among the top central bankers world over. But there is a tradition that governors change. So I think there will be a change happening, though the markets would prefer him to stay. In terms of expectations on the rate cuts, those have moved to February largely. Earlier part of this year, we were expecting that the rates would start getting cut by October, following the Fed cutting by August, September, and that got postponed. Now, the dilemma for the RBI is twofold. One, how to ensure that the rupee depreciation is orderly. They have to keep an eye out for competitive devaluation that the Chinese will be doing, Southeast Asia and Southeast Asian nations will be doing continuously. That's the Chinese rebuttal to Trump tariffs. We have seen that happen in 2017-18, and already the Chinese have smartly depreciated their currency. So the rupee has to be competitive in export terms, but it imports inflation if it's disorderly. So the RBI is in a bit of a cul-de-sac where, on one side, it has to protect the value of the rupee. On the other side, price stability. And third is the growth imperative. The growth has slowed down, and you need counter-cyclical measures both on the fiscal and monetary side. The money market is telling you that with the kind of fall that you have seen in the yields, right from the 40-year paper down to the 5-year paper, and the OIS is showing that a rate cut is anticipated by February and April. So I think if on Friday we don't get a cut, you will get a 50 basis point in February probably. Second would be on the liquidity. The street seems to be quite convinced on a CRR cut. Let's wait and watch. That's again a very blunt instrument. RBI doesn't like to leave that on the table mostly, and rather they prefer OMOs and variable auctions. To ensure they inject liquidity, but it will be a good signaling. If they give a CRR cut, it will help the balance sheets of banks as well. More liquidity and better margins, both will be welcome for the banks. Markets have run up in anticipation. So we'll see on Friday, but it's a tough position to be the RBI governor this meeting between the growth stalling and inflation still being very disruptive, and the third being the protection of a orderly rupee depreciation.
Okay, stay on with us, Ajay. Lots more to talk about, but I'm going to quickly take it back to our chartists and get in some BTST trades as well before we, move on. Naresh, what's on your list?
So first is the buy on ICICI Bank, a leader stock. We're looking at towards a breakout. Stop loss at 13.05, target price of 13.45. Second is a buy on LTF, L&T Finance, which has corrected a lot and is now showing a reversal signal. Stop loss at 146, target price of 153.
Shrikant, what about your BTST trades?
Yeah, I think after this fall, we are seeing good amount of buying interest in number of stocks. In that, real estate stocks are doing well. KEC is on which just now we discussed is very close to its upper circuit, and Coalpal is showing some strain. Currently, it is around 2920, 2925 levels, but after correcting to the levels of 2850, it is reversing back. While looking at the overall setup, I think it is heading for the levels of at least 3,000, 3,050. So Colpal is a buy at current levels with a stop loss close to 2870. And from the cash segment, we like Prism Johnson, which is around 194, 193. The stock has made a multiple bottom close to this 185, 186 level. And from the current level, the stock can move to the levels of 210 or 215. So it is very close to its breakout level. It's a buy at current levels around 194, 195 with a stop loss at 188 on the downside.
Okay, point taken. So those are some of the top recommendations coming in. Ajay, I'm not sure if you track, of course, the Adani Group closely or not, but would you have any recommendations on the Adani Group?
No, particular stocks I would not like to talk about.
As far as the other bits are concerned, this entire BPC category and the overall urban retail and consumption category is something that is coming back to the radar. We were just speaking with the management of DLF Retail as well as to how the Black Friday sales have picked up quite massively. What do you make of this theme?
No, see, overall aggregate demand has come down in the economy. We have seen that with the GDP numbers, and stocks have not performed so well. The expectation now is some counter-cyclical measures. Will the government wait for the budget to come in? And on the other side, will they release big chunks of payouts for projects as well as welfare schemes? That's what needs to be watched out. The Indian consumer, the Indian taxpayer has done their bit by raising the GST levels or the direct tax levels. Corporate tax has not been that good for October, but we'll have to wait and watch the December 15th number. That will give a very good idea of the tax collections. But what we have to really wait for is government disbursals to pick up, and that will then see all the consumption themes picking up strongly. The sowing has been good, and we are expecting rural demand to also start picking up. But a lot depends on the government spending coming in. We lost about 4 months in the beginning of the year. There is that catch up happening. We will not meet the infrastructure capex number for the year that was budgeted. So the government will have a good 50 to 75,000 crores extra in hand, which if they can, dole out between now through February, that can be a good counter-cyclical boost into the economy. So we have to wait and watch for that. There are some segments which are looking very good, and they have also caught the attention of institutional investors like quick service, commerce, and platform companies, which you were discussing earlier. I think those are looking good and they should do well. But right now, I would say public sector, railways, defense. Railways, defense, I have been talking against from about May onwards on valuations. But this is the pre-budget time. You have a 60-day window to get into public sector, railways, defense. They normally do well going into the budget, and then we see a tapering off post the budget. So might not be a bad idea for short-term investments to look at these three: public sector, railways, and defense. A lot of overlap in these three. A lot of them are also public sector companies, but public sector, I think the banks got hit too much, and with the RBI action upcoming, you will see benefits on the treasury as well coming to them. The way the yields have corrected over the last 1 week has given them some boost on the treasury income as well. So I would look at public sector banks as well, along with railways, defense. Again, it's a 60-day trade going into the budget. You will see the normal frothiness coming into all these sectors.
Okay, great to then have you on the show, Ajay. We'll let you go on that note. Good speaking with you as always.
If you like this video, then like, share and subscribe to ET Now.